The global markets are in turmoil as we witness what many analysts are calling the most significant market collapse since the COVID-19 pandemic. Welcome to our in-depth analysis of the current economic crisis triggered by escalating trade tensions between the United States and China, with ripple effects extending to Canada, Mexico, and global markets. April 8, 2025 marked a critical turning point when China, in response to President Trump's sweeping tariffs, devalued its currency to the weakest level since 2023. This move, which many economists are describing as pulling the trigger, has sent shockwaves through financial markets worldwide and intensified fears of a full-blown global trade war. Let's step back and examine how we arrived at this precipitous moment. On April 2, 2025, President Donald Trump announced extensive tariffs on several of America's largest trading partners. These included a cumulative 20% tariff on Chinese imports, implemented in 2 tranches with 10% effective from February 4th and an additional 10% imposed on March 4th. The tariffs weren't limited to China. Trump also announced a 25% tariff on most Canadian and Mexican goods not already covered under the USMCA agreement, plus an additional 10% tariff specifically targeting Canadian energy imports. The official justification for these tariffs centered on addressing drug flows, particularly fentanyl, into the United States. However, critics have questioned this rationale, pointing out that both Canada and Mexico have made significant progress in combating drug trafficking, with data showing a 24% decline in overdoses from September 2023 to September 2024. Many analysts suggest that these tariffs may be more politically motivated than based on national security concerns. The affected countries didn't take these tariffs lying down. China's response was multifaceted and calculated. Initially, they imposed retaliatory tariffs on a wide range of U.S. agricultural products, including chicken, wheat, corn, cotton, sorghum, soybeans, pork, beef, aquatic products, fruits, vegetables, and dairy. They also halted sales to 15 American companies and added more firms to their unreliable entity list, describing U.S. actions as bullying. But China's most significant move came on April 8th, when they allowed the yuan to devalue to its weakest level since September 2023. The People's Bank of China set the midpoint rate at 7.2038 per dollar, while the offshore yuan hit 7.3677, both currencies losing about 1% in April alone. This currency devaluation is a strategic move designed to make Chinese exports cheaper, effectively offsetting the impact of U.S. tariffs. However, it comes with significant risks, including capital flight and increased inflation within China. Financial analysts have taken note of this currency move as a particularly aggressive response. Ju Wang from BNP Paribas highlighted increased expectations for further devaluation, while experts from Mizuho Bank and Macquarie suggested that China would likely limit sharp depreciation to maintain economic stability. Nonetheless, the message was clear. China was prepared to use all economic tools at its disposal in this trade dispute. Canada's response was equally forceful. Prime Minister Justin Trudeau described the situation as a trade war and imposed 25% tariffs on $20.5 billion worth of U.S. goods, with threats of extending these to an additional $85 billion in imports if the situation escalates. At the provincial level, Ontario removed U.S. alcoholic drinks from stores, affecting approximately $700 million in annual sales, while Nova Scotia cancelled contracts with American companies. Mexico, under President Claudia Sheinbaum, vowed retaliation and planned countermeasures, including its own set of tariffs if U.S. tariffs persist. This united front from America's largest trading partners signaled that Trump's tariff strategy would not go unchallenged. The timing of these tariffs raised questions among economic observers. Coming in the early months of Trump's second term, they fulfilled campaign promises to take a harder line on trade, particularly with China. However, implementing such significant economic policies without a gradual approach or clear off-ramps contributed to the heightened tension in international relations. The specific justification around fentanyl and drug trafficking deserves particular scrutiny. While the opioid crisis remains a serious issue in the United States, using broad economic tariffs as a tool to address drug flows represents an unconventional approach to what is fundamentally a public health and law enforcement challenge. Critics have argued that this rationale provides political cover for what is essentially an economic policy aimed at addressing trade imbalances. China's currency move represents a significant escalation in this dispute. Currency devaluation has historically been a contentious tool in trade conflicts, often leading to accusations of manipulation and unfair advantage. By allowing the yuan to weaken, China effectively neutralizes some of the impact of U.S. tariffs on its exports, but at the cost of potentially destabilizing effects on its domestic economy and further inflaming tensions with the United States. The People's Bank of China has traditionally maintained tight control over the yuan's value, intervening when necessary to prevent excessive volatility. The decision to allow significant weakening signals a strategic shift in their approach to this trade conflict, prioritizing export competitiveness over currency stability. This move echoes similar actions during the 2018-2021 trade tensions, though the current devaluation appears more pronounced and deliberate. Financial markets recognized this currency move as the crossing of an important threshold in the escalating trade tensions. It represented a shift from conventional tariff retaliation to utilizing monetary policy as a weapon in the trade arsenal, what many commentators have described as pulling the trigger on a new phase of the conflict. For the global economy, already navigating post-pandemic recovery challenges and regional conflicts, these developing trade tensions add another layer of uncertainty. The interconnected nature of modern supply chains means that disruptions between major economies like the US and China inevitably have cascading effects throughout the global economic system. As we continue to monitor these developments, it's clear that what began as a unilateral tariff announcement has rapidly evolved into a multifaceted economic confrontation with potential long-term implications for global trade patterns, currency relationships, and international diplomatic relations. China has indeed pulled the trigger with its currency devaluation, signaling its willingness to employ all available economic tools in response to U.S. tariff pressure. The question now becomes, what happens next in this escalating economic showdown between the world's two largest economies? With markets already reacting severely to these initial moves, the potential for further escalation presents significant risks to global economic stability in the months ahead.